Have you ever looked at the stock market and just felt completely overwhelmed? I mean, you know there's value out there, but trying to figure out what a company is actually worth, it can feel like you're just throwing darts at a board. How do you invest with real confidence instead of just, guessing? Well, it turns out there's a playbook for this, written by one of the absolute legends of investing. So let's crack it open.
Now get this. The master himself, Benjamin Graham, dropped this quote back in 1976. Think about that. At a time when everyone, then and now, is chasing the next big growth stock, Graham basically said, yeah, that's a sucker's game. He had a totally different approach, a simpler, way more powerful method that wasn't about predicting the future, but about buying proven value right now.
So in this explainer, we're going to walk through his entire playbook, step by step. First, we'll get to know the man himself. Then, we are going to break down his and I mean incredibly simple buying rules. After that, we'll look at how to actually build a portfolio with those rules. And finally, we'll uncover the one secret ingredient that makes the whole thing tick.
So who was this Benjamin Graham guy? Look, he wasn't just some successful investor. They literally called him the dean of security analysts. His book, Security Analysis, became the Bible for Wall Street. Oh, and one more tiny little thing. He was the mentor to a young guy named Warren Buffett. Yeah, that alone should tell you we probably need to listen up.
But this isn't just about his reputation. The proof is in the numbers. Graham spent years testing a simplified version of his strategy, and the results were just staggering. His research showed that a portfolio built on his simple rules would have doubled the performance of the Dow Jones over a 50-year period. That is not luck, my friends. That is a system. Now, you'd think a system that powerful has to be insanely complicated, right? Well, that's the beautiful part. It wasn't. Graham boiled his entire life's work down to finding stocks that met just two basic, super straightforward criteria. This right here, this is the foundation of everything.
Okay, so rule number 1 is all about the price tag. Graham's core belief was simple: only buy things for less than they're actually worth. And to figure that out, he ignored all the hype. He used one simple metric, the price-to-earnings ratio, or P/E. But the real question is, how cheap is cheap enough?
And he came up with this brilliant little formula to answer that, linking stock prices to what was happening in the rest of the market. And it's not scary, I promise. Here's how it works. Step 1, you find the current interest rate or yield on super safe corporate bonds. Step 2, you just double that number. And finally, step 3, you divide 100 by whatever you got. The answer is the absolute highest PE ratio you should ever pay for a stock, period.
So what did that look like in real life? Well, back in 1976, when you ran the numbers, his formula spit out the number 7. That's it. His rule was that simple. If a stock's PE was higher than 7, he wouldn't touch it. It was a clear, unemotional line in the sand. No exceptions.
But, finding a cheap stock isn't the whole story. I mean, it could be cheap for a very good reason, right? Like maybe the company is a total mess and about to go bankrupt. That's where Graham's second rule comes in. He had to make sure the business itself was actually solid.
To check a company's financial health, he focused on one number: stockholders' equity. Now, don't let the fancy Wall Street term throw you. Graham's definition was beautiful. It's just the company's net worth. Think of it this way. If the company sold everything it owned and paid off every single one of its debts, what's left over for the owners? That's it.
And his rule for this was just as simple. He wanted to see that the stockholders' equity made up at least half of the company's total assets. To put it another way, a company should own at least twice what it owes. It's just a simple check to make sure the company has a nice, thick cushion to protect it if things get tough.
Okay, so now we have our two rules. Find a cheap stock and make sure it's a financially strong company. But how do you actually turn those rules into a real-life portfolio? Let's get practical. You might be thinking, come on, do any real companies actually pass these crazy strict tests? You bet they do. Here are just a few examples from 1976 that made the cut. I mean, look at Amalgamated Sugar, a PE of just 3 and an equity ratio of 77%. Or Zale Corp, right on the edge with a PE of 7 and 61% equity. These kinds of bargains were out there then, and they're still out there today if you know how to look.
But, and this is a big but, you don't just buy one of these and call it a day. Graham insisted this is a numbers game. He said you have to build a diverse portfolio of at least 30 stocks that all meet his criteria. Why 30? Because you need a big enough group to let the laws of statistics do their thing. Not every stock is going to be a home run, but the team as a whole is set up to win.
Now, just as important as his buying rules were his selling rules. These were designed to take every last bit of emotion out of your decision-making. He had two. First, a goal-based rule. As soon as a stock is up 50%, you sell it. Take the win. And second, a time-based rule. If it hasn't hit that 50% goal within 2 full years, you sell it anyway, even if it's for a loss. This discipline forces you to cut your losses and put your money to work somewhere else.
So we have the buying rules, we have the selling rules, it's a complete system. But Graham was very, very clear that the numbers alone were not enough. There's one final, absolutely essential ingredient that makes this entire strategy actually work in the real world. So what's the reward for all this hard work and discipline? What's the prize at the end? Graham's research showed that if you followed the playbook, you could expect an average return of 15% per year, or even better, and that's before dividends. That's the kind of long-term payoff this system is built to deliver.
But, and you knew there was a but coming, you have to be prepared for the journey. Graham hammered this home. He warned that you absolutely must be financially and, more importantly, psychologically ready for some bad years. You will see losses on paper when the market tanks. He stressed this is not a short-term game. You have to commit to at least 5 years to let the strategy do its work and ride out those inevitable storms. And that really brings us to the ultimate key to the whole thing. In Graham's own words, success comes from patience and consistency. It's not about being some kind of genius who can predict the future. It's about having the simple discipline to follow a proven set of rules over and over again for years and just letting the law of averages work for you. So the final question really isn't whether the system works. We know it does. The question is, do you have the patience to let it?